So what happened in 2021? Let's go through the key events and what are some of the lessons we can learn from them. So beginning in January, we had the GameStop craze and the rise of meme stocks. So that was a big thing in 2021. So what happened? So basically, GameStop is a company that is very unprofitable, which has very bad fundamentals, which is a crap company. But what happened was that a lot of retail investors on the Reddit forums, Wall Street Bets, they decided to collectively buy GameStop. So everyone started buying GameStop, and because of the intense demand for the shares, it sent the stock up like 3,000%, something like that. And a lot of the big hedge funds that were short the stock, suddenly when they saw the stock price rise, they lost millions and millions of dollars. So that was kind of like the retail investors taking revenge on the hedge funds, saying that, collectively we can screw you back. So that gave rise to the meme stock craze, which is basically stocks that go viral, that everyone is talking about on social media, and when everyone jumps in, these stocks can go crazy. Even though the underlying business is losing money, the underlying business is not worth much, but the share price can go up a few thousand% within a short period of time, making some people rich. And of course, most people will end up losing everything because eventually that will burst and it comes crashing down to earth. So it started with GameStop, and then it went on to AMC and BlackBerry. So we had these huge runs and collapse. So that was the first interesting phenomenon in 2021, this meme stock thing. So it will happen again. Another meme stock will appear, it will rush up, it will burst, and it's going to collapse, right? Pretty much like a Ponzi scheme, if you ask me. Now, so then we went into March. So in March, all hell broke loose in the technology sector, especially those tech stocks that were overpriced and unprofitable. So what happened? It all started with treasury yields rising. So treasury yields are the 10-year bond yield. So the 10-year treasury yield was below 1%, which means interest rates were really low. And then what happened was the interest rates on the 10-year bonds suddenly flew up to 1.75%. And so this caused the tech stocks to collapse. So what happened was in 2020, many of these unprofitable and overvalued tech stocks were flying up like crazy. Like, for example, you had Peloton Interactive, you had what else? You had Zillow, you had Roku, you had Fastly, and you had Teladoc, you had DocuSign. So a lot of these, and you had Zoom, for example. So a lot of these stocks were owned by ARK ETF, the ARK Innovation ETF. So these stocks and the ARK ETF went crazy in 2020. They had huge returns. But, if you watch my videos, I told you guys stay away because many of these stocks are unprofitable, they are overpriced, and they will collapse once interest rates rise. And sure enough, when interest rates rose, the long-term rates rose above 1.75%, the bubble burst on these overvalued tech stocks. And since then, like Zoom and Zillow and DocuSign and ARK, they've dropped 30, 40, 50, 60%. So that's what happened in March. And then we had the Archegos Capital blow up. Archegos was a hedge fund run by Bill Hwang, and they over leveraged and they basically blew up, right? And it took down Discovery, Viacom, and some of these Chinese tech stocks went down because of a forced selling that was imposed on Archegos by the investment banks. And a lot of these investment banks lost money as well. So that's what happened in March. In May, we had inflation getting a bit crazy. So for the longest time, the Federal Reserve said, don't worry, inflation is not going to go up. So inflation has remained low for a long period of time, below 2%. And the Fed was saying inflation will remain there. And the next thing you know, inflation jumped 4.2%, which is the highest inflation rate in many, many years. So the market freaked out and came down. Then in June, the Fed started saying, okay, with this high inflation rate, but we think it's going to come back down, all right? We don't think it's permanent. It's transitory, but we may start tapering, which means we will start reducing our bond purchases, or basically they are going to stop printing so much money. So that's what happened in June, and that caused the market to again correct again. Then in July, we had, Delta variant. So when everything looked like it was under control, the borders were reopening, Delta variant, more contagious. So that freaked the market out, market corrected again. And then the Chinese government started cracking down beyond the tech sector. They started cracking down on the private education businesses, saying, we're going to make all you guys non-profit companies. So the market freaked out and said the Chinese government is going to destroy capitalism. We're going to go back to communism, and the whole Chinese market collapsed. And that again infected the US markets as well and other global markets. Then in September, we had the China Evergrande crisis, which is this big Chinese property developer that on the brink of default. They say if it defaults, it's going to drag the whole property sector down, and Chinese GDP, which depends on property, is going to collapse. We're going to have a Lehman Brothers moment, and people freaked out, right? And I said, it's a nothing burger. I said, oh, relax. It's not as bad as it looks. And then in November, we had the Omicron variant now. Okay, now we've got Omicron, all right? And then the Fed confirms we're going to reduce we're going to start our tapering. We're going to cut our quantitative easing by March or June in 2022 because of sustained inflation. So the Fed finally admitted that inflation is out of control. We have to start to increase interest rates. We have to start to reduce our money printing. And so the market came down again, right? And then, of course, in November, we had this, again, big hoo-ha about Chinese stocks there's going to be delisted from the US markets. So again, that caused the November sell-off. So again, what has been driving up inflation? And inflation, by the way, in November was recorded to be 6.8%, which is the highest inflation rate in 40 years. So that's significant. And so this high inflation is caused by both demand and supply. Okay, too much demand, not enough supply. So the demand is caused by a lot of pent-up demand. People want to go out and buy stuff, right? But not enough supply, caused by supply chain issues because of the ports being closed down, labor shortages, COVID lockdowns, shortage in semiconductors. So because of the lack of supply, excess demand, we've got inflation. Okay, so these are all the things that happened in 2021. So what are the lessons to learn? The first lesson is to never chase short-term outperformance. Now, what does that mean? The trouble with a lot of investors is they tend to look at the rear view mirror in making decisions for the future. So in other words, they tend to look at what did well last year and they buy that. And that's the worst thing you can ever do. Because what tends to happen is that when something does very well in a certain year, it tends to not do well in the next year. All right, because remember, the market doesn't go up in a straight line. Stocks don't go up in a straight line. They move in cycles. So you've got cycle up, cycle down. So it's always a cycle. And the trouble is when a stock tends to have a very strong run, it tends to be overpriced. Usually, not always, but usually. And that's when people tend to jump in because they jump in thinking, hey, it's done so well. People have become rich. I also want to become rich, so I want to do well. And they always jump in at the top. And that's why after they jump in, they get destroyed because they always look at the past. But the past is not the future. In fact, the future tends to be the opposite of the past because it's a cycle, right? So again, last year, what happened? Last year, a lot of these tech stocks did really well. This is Zillow. This is Peloton. This is Teladoc. This is Zoom. And of course, ARK buys many of these companies that went up really well last year. So a lot of people saw that and said, hey, these are great stocks. These are great companies, ETFs. So they bought in the start of 2021 or the end of 2020. And sure enough, they got killed because they were chasing short-term outperformance. So remember, never chase a stock when it's going up. I always say never chase the girl, right? So always buy when the girl is running into your arms, all right? So you buy when there's fear, when there's panic, because that's when you get an undervalued price. You always buy when the price retraces near the moving averages. And once the price runs away from the moving average, gets overpriced, that's when you don't want to touch it. In fact, you could start to sell to take profits if it is way overvalued. So never chase short-term outperformance. Number two, and related to number one, is never chase hype stocks. So what are hype stocks? Hype stocks are stocks where the underlying business is not really making money, but the price went up purely based on hype. And when the company is not really making money and the price is going up, very often is a lot of optimism and emotions and FOMO driving the stock price up. And companies like Zillow not really making money, Peloton not making money, Teladoc not making money, Roku not making money. These are all unprofitable companies. Sea, which owns Shopee, not making money, but going up like crazy, again, driven by low interest rates, money printing, and you buy at the top, obviously going to lose money, right? And of course, that's what happened to ARK. People jump into ARK and, ARK started coming back down to reality. So as an investor, it's always important to stick to the principles of only buying companies that are consistently profitable, only buying them when they are undervalued, and only buying them when the price has retraced down to near the moving averages. And the trouble was, a lot of people in 2020, they broke this rule because they saw people making so much money. They got seduced by the hype. They started buying all these unprofitable, overhyped companies, thinking that it's going to go up forever, and they paid the price. So that's why I keep saying, don't get jealous when people are making money in the short term, because it never lasts. You got to stick to your principles of buying solid companies that are undervalued, because if you do that, in the long run, you will always beat the market. You will always be profitable. So that's lesson one. Lesson number two. Now, a lot of people ask me, Adam, do you think it was a mistake for you to buy Alibaba or Tencent or the Chinese tech ETFs? Was it a mistake? Now, I don't see it as a mistake at all. Why? Because when I bought Alibaba, it was already it's a good business. It's undervalued. When I bought Tencent, it's a good business. It's undervalued. When I bought the Chinese tech ETFs, it was undervalued. But undervalued became even more undervalued, right? So after I bought it, it still went down 20, 30% below my purchase price. So when that happened, do I look back and say, darn it, I made a mistake. I shouldn't have bought it. I should have avoided it. No. So to me, it's not a mistake. Why? Because when I bought it, it met my investment criteria. It was a good business. It is undervalued. And there's no way I can predict that it's going to go lower. No one can predict that, right? So if it's something you can't predict, if it's something that you can't control, it's not a mistake. Okay? Now, what is a mistake for some people is that they over allocate their portfolio into a few companies. So one of the lessons I keep teaching is this. When you invest in a great business, it will always come back eventually. But the problem is you don't know when it will come back, right? So in the short term, it could still go a lot lower by 20, 30, 40, 50%. And that's why it's very important that no matter how much conviction you have in a stock, you never put all your eggs in one basket. You never over allocate. You always diversify your portfolio into at least 10 companies minimum. So if you buy at least 10 companies, each company would take up a 10% allocation. If you buy 20 companies, then each company will take up a 5% allocation. So when you have a small allocation to each great company, even if one of them goes down temporarily because of things that are out of your control, like Boeing went down because of the plane crash, a pandemic, Alibaba went down because of the crackdown, even if that happens, it doesn't matter, because it only affects your portfolio in a small way. But the other companies you own, which are just as good, will go up and make up for that temporary drop in that underperforming stock. So for example, if you look at my portfolio, these are my stats, right? So you can see that currently in my main US portfolio, I've got 78% in US stocks and 16% into China stocks. Now, it was 20% initially, but since my Chinese stocks have dropped, now you can see it's made up 16% of my portfolio. So I intend to keep it that way and not over allocate. And from the stocks in my US portfolio, for example, you can see it's broken down into about 30% technology, 22% consumer discretionary, 12% communications, 10% healthcare, 8% industrials, about 3.8% consumer staples, and 3% financials. So again, within the market, within the US market, I also ensure I'm diversified. So for example, in March, during the technology stock crash, my portfolio was not that affected because not everything went down. Only the technology stocks went down, right? Which made up 30% of my portfolio, but the other 70% of my US stocks went up. So that kind of like buffered the drawdown. So again, what's really important is to not only grow your portfolio, but to do it with as low volatility as possible. And the way to do that is, again, to diversify across major sectors, across different great companies. All right, lesson number 3 is be mindful of the bubbles in the market. Now, people have again been saying, hey, is the market in a bubble? The market seems really expensive. And I keep saying that generally the whole market is not in a bubble. I think it's fairly priced. It's not cheap, but it's not insanely expensive as well. And I'll talk more about that later on. But I've been saying this for many, many times that there are pockets of the market that are in a bubble. Now, one of those pockets has already burst, and that's the tech bubble in certain stocks, like again, Zoom and Zillow and Roku and Peloton and Fastly. That has burst already, and it's down like 50-60%. Although I still think it's expensive, may go down a bit more, but that bubble has burst. But there are other bubbles that still exist in the market today. And of course, the bubble would be cryptocurrencies, electric vehicles, and NFTs. And again, I'm not saying it's going to burst now, but it will burst eventually. The trouble is no one knows when it's going to burst, right? But it will burst eventually. So I need to be mindful that there are these bubbles in the market. Now, let's go back to history and let's understand how bubbles are formed, okay? So let's go back to the 1920s. Now, if you remember, if you read history, in the 1920s, there was a big bubble in automobile companies. All right. Any company, any stock that had the word motor went crazy, went up 3, 4, 500%, went nuts, right? Even though the companies were not making money, even though the companies overpriced, it kept going up, right? Why? Now, remember that bubbles are always formed because of some grain of truth. There's some truth to it where the bubble forms around that truth. And people, because of the belief in that, they are willing to pay any price. So what happened in the 1920s? In the 1920s, people were saying that horses were going obsolete, right? No one's going to ride a horse anymore. Everyone's going to buy a car, which is true. It is correct, right? But so that's what fueled the bubble, right? So everyone bought auto stocks and they went up like crazy, but eventually it burst and 99% of all those auto stocks went bankrupt eventually. That only 1% survived. Now the problem is you never know which is going to be the 1%. And that's why I keep saying that never buy stocks that are unprofitable. Because you may say that, hey, one day it's going to be profitable, right? But you never know which one is going to be, right? You never know which is going to be the 1%. So you only want to buy when it has proven itself, when it has become consistently profitable, okay? Now, then in the 1960s, it was electronics company. Any stock with the word tronics went crazy, right? The stock went to the moon. Even though, again, the companies were not making money, were not unprofitable, it went up like crazy. Why? Because at that time, the belief was that micro electronics, transistors would change the world, which is true. It did change the world, but not all the stocks made it, right? So the bubble was formed, and again, 99% collapsed and died, and only 1% made it, right? And of course, in 2000, and this is something that I think most of you at around my age, you'll be fresher in your mind, the dot-com bubble. So in the dot-com bubble, again, anything with the word .com went crazy. And again, these were companies that were not making money. They were like, whoa, right? And eventually the bubble burst, and 99% of the companies all went bankrupt. And the 1% made it. And the 1% was like Amazon, for example, and a couple more, right? Now, so understand this, what happens. Whenever there's something new, right? You have a bubble, it collapses. But remember, there's truth to the bubble. There's truth to automotive replacing the horse. There's truth to electronics changing the world. There's truth to online companies overtaking brick and mortar. It is true. But oftentimes it takes many, many years for the really profitable companies to prove themselves. So if you look at the dot-com bubble, it burst in 2000, right? And it took about 6 years to break even. If you bought at the top, it would have taken you 6 years to come back to where it was. Okay, and again, not all of them came back, right? Remember that only the surviving ones came back. So you got to be careful about that. So it's happening in the market today. So today, what's the grain of truth? The grain of truth is that people are afraid that, hey, you know what? There's hyperinflation. They keep printing money, and and that's why we want to buy crypto, because crypto will replace fiat currency. There's a bit of logic to that, right? Or, electric vehicles will replace petrol vehicles. And it's true, it will eventually. But right now, it's a bubble, all right? So right now, we're at this bubble stage, okay? Eventually, it's going to collapse. And again, 99% of electric vehicle companies, of NFTs, of cryptocurrencies will all go to zero, right? Only 1% will survive. And, who knows what the 1% is going to be. And the 1% that will survive, they will take 5 years to make back the losses. And that's only the 1%. So just be aware that there is that bubble in the market. And for those of you who have been asking me, Adam, why don't you buy electric vehicle stocks? Why don't you buy NFTs and cryptocurrencies? That's why I stay away, because, I'm the kind of person where I only want to invest in things that I know 100% I'm going to make money, all right? I don't want to buy something where, only 1% chance of making money. And because I'm looking at the long run. It's not about making a lot of money in the short term and losing it all next year, but it's about how do you consistently make money and grow your wealth over the long run, because this is your future financial freedom and security that we're talking about. Lesson number 4, and this is a lesson that is repeated year after year after year, which is keep buying fundamentally good stocks as long as they're undervalued during times of correction. And it's usually coupled by bad news. So buy when people are freaking out, buy when there's bad news, be greedy when others are fearful. And that's how we get double-digit gains in the markets. And if you guys recall, back in September 28th, I released a YouTube video talking about the sad face indicator. And I said, every time you see a sad face on the media with the words, worst day, that's one of the best times to buy into the market. Now, it doesn't mean it's always at the bottom. It could go a bit lower, all right, for a few more days, but generally you'll be buying near the bottom. So let's take a look at 2021. At all the times this indicator appeared, you got a sad face with the words worst day, all right? So let's check it out. And the first time it appeared was on the 20th of January. So again, US stocks have their worst day. You gotta see the words worst day, and you gotta have a guy with a sad face. So his face looks pretty sad, as you can see, although it's covered by a mask, but he looks pretty sad, right? Okay. And again, if you had bought that would have been a great entry to get into the market. Next, it appeared here again, and again, this was on a May 12th. Dow drops more than 600 points post worst day. And again, you've got this guy with a really sad face looking down, right? And again, this was a great time to also add shares. Next one, okay, this guy's holding his mouth, looks really sad as well. July 20th, global shares stabilized after Dow's worst day of 2021, right? And again, this happened right at that thing. So notice that every time the market has wave up, wave down, wave up, wave down, wave up, wave down. Every time there's a wave down, a wave down, a wave down, and you see a sad face with worst day, generally it's a great time to add shares. So this was the third time it happened. And the fourth time it happened was right here. Okay, this was on the 19th of September. S&P falls for its worst day. Again, guy with the sad face. And again, if you entered there, it was not the bottom, right? It still went a bit lower, sure, but eventually went back up again. So like I said, you don't always get exactly the bottom, but somewhere near the bottom, as long as you don't buy near the tops, right? The idea is to buy near the bottoms, not near the tops. All right. And the fifth time, so this indicator appeared 5 times in 2021. The fifth time we had this guy with a really, really upset face. November 25th, Dow tumbles for worst day of year on fears of COVID variant, right? So again, it was there, went a bit lower, went up, and then eventually ended with a double-digit gain on the S&P 500. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.